Topic: An introduction to portfolio rebalancing strategies examines how investors maintain target asset allocations through systematic portfolio adjustments over time. Portfolio rebalancing is necessary because asset prices fluctuate continuously, causing portfolio weights to drift away from strategic targets. Without rebalancing, risk exposures may increase unintentionally, and portfolio objectives may no longer align with investor preferences. The topic focuses on dynamic trading strategies, which involve ongoing adjustments to portfolio allocations in response to changing market conditions. These strategies are particularly important for institutional investors managing diversified portfolios containing both liquid and illiquid assets. Effective rebalancing helps investors control risk, maintain diversification, and improve long-term portfolio discipline in evolving financial markets. Dynamic trading strategies represent the core framework discussed in the topic. These strategies involve continuously modifying portfolio positions as asset values and market conditions change. Common approaches include buy and hold strategies, constant mix strategies, constant proportion portfolio insurance, CPPI, time invariant portfolio protection, TIP, and option-based portfolio insurance, OBPI. Each strategy responds differently to rising or falling markets. For example, a constant mix strategy systematically buys underperforming assets and sells outperforming assets to maintain target weights, while CPPI dynamically increases risky asset exposure during rising markets and reduces exposure during downturns. The topic emphasizes that dynamic trading strategies require disciplined implementation and careful monitoring because they directly influence portfolio risk, return patterns, and downside protection characteristics. The topic also evaluates the performance characteristics of different dynamic trading strategies under varying market environments. Certain strategies perform better in trending markets, while others are more effective during volatile or mean-reverting conditions. Buy-and-hold approaches may outperform during strong, sustained bull markets because they allow winning assets to appreciate without constraint. In contrast, constant mix strategies often perform better in volatile markets because they systematically buy low and sell high through rebalancing. Portfolio insurance strategies, such as CPPI and OBPI, aim to protect against downside risk while preserving upside participation. However, these strategies may underperform during rapid market reversals or periods of extreme volatility. The topic stresses that no single strategy consistently dominates across all market conditions and investment objectives. Risk management plays a central role in portfolio rebalancing decisions. Rebalancing strategies influence both return potential and portfolio volatility by determining how investors respond to changing market conditions. Dynamic trading approaches help maintain alignment between portfolio allocations and investor risk tolerance over time. However, frequent rebalancing can generate significant transaction costs, tax consequences, and operational complexity. Investors must therefore balance the benefits of maintaining target allocations against the costs of implementation. The topic explains that successful rebalancing frameworks require clear rules, disciplined execution, and appropriate thresholds for portfolio adjustments. Institutions also consider liquidity conditions, market impact, and portfolio diversification when designing rebalancing strategies capable of supporting long-term investment goals across different economic environments. A particularly important aspect of the topic is the application of dynamic trading strategies to portfolios containing illiquid assets such as private equity, real estate, infrastructure, and hedge funds. Illiquid assets create additional challenges because they cannot be bought or sold quickly without significant costs or delays. Portfolio weights for illiquid investments may drift substantially from target allocations due to changing market values and irregular cash flows. Investors must therefore incorporate liquidity management, capital calls, and uncertain distributions into their rebalancing processes. The topic highlights that traditional rebalancing models may not work effectively for illiquid assets because transaction timing and pricing flexibility are limited. Institutions often rely on forecasting models, commitment pacing, and liquidity reserves to manage these constraints effectively. The topic concludes that portfolio rebalancing is a critical component of long-term investment management and risk control. Dynamic trading strategies help investors maintain discipline, preserve diversification, and adapt portfolios to changing market conditions. However, strategy selection depends heavily on investor objectives, market expectations, liquidity needs, and tolerance for downside risk. Portfolios containing illiquid assets require particularly careful management because transaction flexibility is limited and cash flow uncertainty is high. Successful investors develop structured rebalancing frameworks that integrate risk management, liquidity planning, transaction cost considerations, and long-term strategic objectives. Ultimately, the topic demonstrates that effective portfolio rebalancing is not simply a mechanical process, but a strategic discipline that significantly influences investment performance and portfolio stability over time.